Welcome to This Is Money podcast, sponsored by Charles Stanley Direct. I'm Georgie Frost, and joining me and Lee Boyce today is Helen Crane. And coming up, the Bank of England has cut interest rates again, but this time the decision wasn't straightforward. What does the division in the MPC tell us about the state of the economy right now, and what does the cut mean for your money? Also today, plans to hit those in wealthier areas with bigger council tax bills. Will you be affected? Crane is back on the case, this time helping an elderly couple get money back from their water company for ruining their garden. And Lee will help you work out if you can claim from the car finance scandal and what to do if you can't find the paperwork. Don't forget to stay up to date with all the latest breaking money news. Just go to thisismoney.co.uk or download the app.
Take control of your finances with Charles Stanley Direct. Invest, save, coach, or plan. Using technology where it's helpful and people where it matters. Our website and app make trading cost-effective and flexible. But we're more than just an online investment service. We're here for you regardless of your financial needs or if your life takes an unexpected turn. Your finances, your way. Take control today with Charles Stanley Direct. Sign up now.
Investment involves risk.
But first, it was no great surprise that interest rates were cut this week. What caught people off guard was the indecision around the vote. For the first time in its history, the bank's Monetary Policy Committee was so split that it had to vote twice. One member even backed a bigger cut before switching sides in the second round. In the end, a narrow 5-4 majority brought the base rate down from 4.25% to 4%. So, what does this mean for our money, the economy, and the government's plans? Lee, Helen, welcome. Lee, what happened? Excitement. Why the split?
Oh, Georgie, it was so exciting. You know, these things can sometimes be a little bit dull when you're reporting on them and you're sitting around in the office going, oh, it's a base rate decision today. Oh, you know, it's a hold, or okay, it's a small cut. Oh, it was exciting, Georgie. It was exciting this week. It was a three-way deadlock, which sounds like something you'd hear on the X Factor. It was very, very exciting. So you have 9 members of the Monetary Policy Committee who make these decisions on where base rate is heading. 4 voted for a hold. 4 voted for a fall to 4% from 4.25%. And 1, Alan Taylor, went for a 3.75% rate. That's what he thought, 0.5 percentage point. He went all guns blazing. And then I'd like to think the drama unfolded and he had to be talked around to temper his rate cut aspirations to just 4%. Interestingly, though, what has happened in the aftermath of this is it looked very nailed on that there was going to be another cut this year. But markets now are less certain. So before the announcement yesterday, there was a 100% chance, according to the markets, of another rate cut. That's now fallen to 72% in the aftermath of this decision, which would have been some of the uncertainty and the fact that 4 members voted for a hold. So they're less than certain that rates should be falling. Inflation, the dreaded inflation word, is starting to creep back up again, and it's expected to go to 4% next month, up from previous forecasts of 3.5%. The Bank of England actually referenced supermarket shopping bills, our grocery bills, as a big driver of this, and that national insurance contribution hikes from the budget last year are really starting to bite at the supermarket tills, and that is what is causing inflation to tick up a little bit again. Referencing that, showing potentially, you know, just how devastating that has been for job markets and also the price that we pay for items on an everyday basis. Now everything feels a little bit up in the air as to where it goes next. And I was saying to Helen this morning, the thing is, 4% feels like a very sort of smooth figure, doesn't it? It's very kind of rounded. It's very kind of, you could see them parking the bus, so to speak. We also discussed that Alan Taylor sounded a bit like a Premier League manager from the 2000s. You know, to go back to football analogies, you know, could they park the bus? If you've got 4 members of the MPC voting for holds, you can see why the markets are pricing potentially a little bit more uncertainty as to the next steps. But look, it's good news for potentially for your mortgage, not such good news for your savings. For example, we've seen a fair few ISA rates already being cut away from this decision. Mortgage rates, Helen will discuss with you, I'm sure, in a sec. But for your money, that looks like a better move. But the economy as a whole, it's all just got a little bit murkier again.
Helen, I'll get to mortgages and savings in a minute, but this was ultimately a decision between, do we try to bring down inflation, and the way that you would do that is increase rates or hold them where they are, or do you try to stimulate the economy? And in this circumstance, it looks like the terrible growth figures that we've been having recently is the thing that's won out. However, people would be forgiven for asking, we've now had 5 base rate cuts, and yet still the economy looks to be in a really pretty rubbish state. So why is it not working?
Agreed. I think it was a genuinely very difficult decision, this one. People were anticipating a definite cut. And, while they did cut it, it's clear from the way that the votes fell that there is that sort of standoff between growth and inflation, and do you go and stimulate the economy and hope that people spend more? Those two things are really still in conflict. And if you look back to this time last year, the financial markets were expecting that base rate would come down quite consistently. There'd be more cuts probably in the last year than there have been. As you say, there have been 5. I think ultimately, as Lee said, we'll probably get to a point where rates tend to kind of stick around this kind of point. 4%, it isn't an incredibly high interest rate by sort of historical standards. And I think people might just have to get used to the fact that we are in a bit of a higher rate place. And, this is kind of where things are now while we balance the growth and the sort of risk of inflation.
So whenever we talk, let's go back to mortgages then, whenever we talk about interest rate cuts or increases, the first place we land is people with mortgages. Now, why this is sort of a so-so decision for people is the vast majority of people aren't on trackers. I mean, you will automatically see a drop if you're on a tracker rate. Most people are on fixed rate, and of course you won't notice anything until you come off them. And also there's an element of this had already been priced in, hadn't it, Helen?
Yeah, exactly. So every time there's a base rate cut, it is good news to an extent for people who have a mortgage. But as you say, if you're fixed into a 2, 3, 5 year fix, as the majority of people are, you're not going to see any change until you come to your next sort of remortgage deadline. If you're on a tracker, as you said, you will see your rate go down by 0.25% pretty immediately. People on standard variable rates as well, which again is a small-ish number of people, will tend to see their rate go down by about that much as well. So say if you had a £200,000 mortgage on a 25-year term on a sort of roughly average rate, you'd probably save about £30 a month off your mortgage payments if you did see it go down by that 0.25%. So nothing to be sniffed at. But as you say, lenders tend to price this in, so most people won't see that exact cut that is the same amount as the base rate. Banks are essentially looking at where will rates be when those fixed mortgages are further down the line. So when a 5-year rate is sort of 4 years in or 3 years in, where will interest rates be then, and will the banks still be making money on the loan? So they tend to look more at a general trajectory rather than, the base rate's being cut by this much, so we'll cut our mortgage rates by this much. I mean, it's good news, but it's not an immediate cut.
You can get under 4% at the moment, a lot better than the 6.85, I believe, Helen, that you could have got back in summer 2023. But for those 900,000 people coming off their 5-year fixed rate mortgage that they'd got pre-pandemic, those glory years of you could get sub 1%. I don't think we'll be saying that anytime soon. For those people, they would have been praying for Alan Taylor to have won out, wouldn't they?
Big Alan, yeah, they're very much team Alan. I think, there's this dichotomy between people who are coming to the end of a 5-year fixed rate mortgage at the moment. So they would have locked in their mortgage in the pandemic boom days of 2020 when, house prices were soaring, but the cost of interest on a mortgage was still really, really low. So they could still be on 1%, 2%. I've got friends who bought a house at that time, they wanted to move because they had a baby, and they were actually, do you know what, we won't. We'll stick our mortgage out because it's so cheap. It makes absolutely no sense not to. So those people are going to be coming in for a bit of a shock if they need to remortgage soon. But then on the other hand, we've now got people who took a 2-year fix in 2023 when rates were still really, really high. So this was coming off the back of that mini budget rate spike when the market sort of went nuts. And then there was another spike in sort of mid-2023 off the back of some sort of scary inflation figures. And they could be on rates, some of them, of 5%, maybe even going to sort of 6%. So actually, even if they have to fix it, as you say, some of today's best rates of less than 4%, that's actually great for them. So it just shows how the mad sort of up and downs that we've had in the last year or so, that there are people coming off their mortgages and looking at vastly different rates.
We saw, didn't we, Lee, this week that 5-year fixes are now more expensive than 2-year fixes, which the experts are saying, well, it's good because it shows a bit of normality at last is coming back to the market. Do you agree?
That's right. So historically, Georgie, a 2-year fix, you would typically get a slightly lower rate than you would on a 5-year fix. That flip reversed in the last few years. So a lot of people have got used to 5-year fixes actually being slightly cheaper than the 2-year fix. That has now flip reversed again. Those with the biggest deposits, you can now get a 3.73% 2-year fix, while the lowest 5-year fix is 3.86%. That signals a slight return to some what you would call normality to the mortgage market. But I think crucially, what these small incremental reductions in mortgage rates does is it kind of sparks a bit of a confidence in the property market, helps it get moving again. I think actually the mood music in the property market the last couple of months has been shifting again a little bit with the affordability changes for first-time buyers, for example, and now seeing rates sort of edging down slightly. It should mean that there might be a bit more of a buoyant end to the year for the property market, which is already kind of holding up anyway, to be quite frank.
As we said, Helen, banks priced in pretty much this cut. So mortgage rates, if they trickle down slightly, maybe no big moves. I tell you what they do quite quickly, though. Savings rates. Yeah, they've got no qualms about bringing them down. So what should you be doing right now, Helen?
Yeah, it's funny that, isn't that, how they're quite quick to bring the rate down. As we've been seeing for a while, savings rates have been trickling down. So always worth checking your deal. In particular, are you earning above the rate of inflation on your money, which currently is 3.6%. So if you're not, then that means that you're losing money in sort of real terms. So do check it. And, they're still good deals out there. So there have been already a couple of cuts since you've had that base rate announcement. The top easy access ISA has, it's CMC Invest, it's gone down from 5.44% to 4.59%. Still beats inflation though. And do have a look at our savings rates tables. There's still rates out there well above sort of 4%. So worth checking them out and switching if you're not happy with the rate you're currently getting, or indeed if your bank slashes the rate you're on.
Just quickly on the savings front as well, Georgie, I should point out here, we did speak to savings expert Andrew Hagger. He says if there is another base rate cut this year, we'll probably see the best paying easy access rates go under 4%, so probably more like 3.8, 3.9%, and the best fixed rates to go to 4.1 for 1 year. That's quite a big fall in the last 2 years when you consider the top of the market, that NS&I 1-year fix in October 2023, which was paying 6.2%. So it shows that everything is edging down in terms of savings, which you would expect with base rate decisions going this way. What do I think happens next? Well, I can only go by what the markets are saying. It's still quite a strong chance that there's going to be another fall either in November or December. That's what they're pricing in. If you've got someone like Alan Taylor that already thinks that it should be 3.75%, I find it difficult to see him changing his mind, if I'm being honest. It depends, obviously, on whether those who thought there should have been a hold at 4.25% are going to change, and what their other 4 members, the ones that voted for this cut, whether they believe there's justification. I think we need to keep an eye on what's going to happen with inflation, where inflation heads. If they're predicting 5.5%, but it comes in a bit above that, that again could change the confidence in what happens next to the base rate. So I kind of, as I alluded to earlier, I think that round 4% figure, you can kind of see the argument to keep it there till the end of the year. But equally, there's still a very strong chance that there's going to be one more cut. I'd be surprised if there's more than one more cut, and that's what is being priced in at the moment.
All right, then, we'll leave it there. We'll move on to council tax. It's an expensive and completely illogical system. Bans drawn up in 1991 often make no sense today. So why, for example, should someone living in a Band H property worth over £320,000 in one of the wealthiest areas in the country, Westminster in London, pay £2,034 a year in council tax, while someone in a house in the same band in Bishop Auckland in Durham pay £4,279? Well, maybe no more. Deputy Prime Minister Angela Rayner is mulling an overhaul of the council tax system to allocate more money to deprived areas. So it will mean households in wealthy areas, including London and the home counties, will be hit with huge council tax increases. That's according to the IFS. So how will your area be affected? And are there more council tax rises on the horizon? Oh, Helen, council tax. Firstly, why is the council tax system, frankly, a bit shambolic?
Well, as you said, it's all based on how much your house is worth, which first of all isn't necessarily a great system because, as you said, it means that people in wealthy areas can end up paying less than someone who lives in a much more deprived area because they, in relative terms, their house in 1991 was in a higher band. So it's all a bit mad. I think it's definitely sort of ripe for reform. And as you said, it also has this trade-off with how much councils sort of want to charge and how much they need to raise. So, for example, I live in Wandsworth in London, which has notoriously one of the lowest council tax rates in the country, certainly in London. And they do that as kind of because they can. They're a relatively sort of wealthy council, and they do it as just a bit of a sort of bung to get some kind of goodwill from their residents. I think, you know, they're all shouting about it, like, oh, we have the lowest council tax in London, like brilliant. And you know, they can do that because they're a sort of relatively wealthy London council where, you know, you obviously have these council in deprived areas who don't have that luxury, and their residents sadly end up paying sometimes the same amount as people in sort of London in the south.
Lee, what are your thoughts?
You know my thoughts, I think, Georgie, on council tax from probably what I've been discussing here, and it is constantly being kicked around a bit at the moment, including last week. I don't know if you saw this, but James Buckley, who played Jay Cartwright in The Inbetweeners, was moaning on his podcast about now having to pay for his green bin, saying, I already pay council tax. Why am I having to pay for my green bin? And it went absolutely wild. It went viral. It went absolutely everywhere. And actually, the council that he lives in is the same as my in-laws, who will also say, why are we now paying for our green bin? And I think that's the kind of like bit of frustration and how many more things could potentially be added on. Now, just to go Wandsworth, right, as Helen says, one of the cheapest areas for council tax. What they're proposing here is that there's these rich areas that are paying not much council tax, and then it should be more spread around deprived areas. But let me tell you something, Georgie. Wandsworth is not all sunshine and kittens. I went to Roehampton University. Roehampton's in Wandsworth. Roehampton is not a nice place. Very different to other parts of affluent Wandsworth. Our office is in Kensington. Now, the first thing you say, Kensington, lovely area, very affluent, lots of rich people, supercars going up and down the high street. I tell you, if you take a wander up to North Kensington, or if you go to West Kensington, completely different ball game. Very deprived.
I used to live in Fulham and I worked at a food bank there, so I'm very aware that very rich areas have their own problems.
So where I'm getting at with this is how do you justify what's deprived and what's not deprived? You can't just simply say the north is more deprived than the south. Yeah, okay, on a whole, yeah, but on a granular level, completely different. And there's pockets around all affluent areas on the whole, again, that's a bit of a sweeping statement, that are deprived enough as it is. Where do you draw the line? How do you decide all this? I think the council tax system is as ugly as it is, and reform is needed. I think the reform is so complicated. It's complicated to work out what on earth it is you're meant to do. And we've already seen rises in some areas, green-lit 9% for this financial year. The IFS report that this is coming from is suggesting that some councils could hike rates higher than the 4.99% maximum without the need for a local referendum applying to ministers for permission to raise rates. It's a complicated beast, and I think to just simply say, well, Westminster, they're not paying much on council tax, let's just raise it there. It just doesn't add up. I mean, it just, based on a system from the early 90s of what your house price is worth, it is a very strange, very ugly, very difficult to reform system because it rakes in so much money. And it's raking in more and more money, but lots of local council budgets are totally and utterly annihilated, and they cannot seem to get the balance right. So I think there's going to be a lot of kicking and screaming about this, depending on what is decided to be done.
Any ideas? Do we know who's going to be affected? How much more they'll have to pay? I mean, even if you're not affected by this, council taxes are going up every year. That's not going to stop anytime soon, is it?
Yeah, exactly. Yeah, all council taxes are going up every year. And this IFS report is essentially just saying there's a reform going in and a quarter of councils lose money in real terms. And there'll be winners and losers in this. And some of the ones that they've picked out, IFS says the biggest losers will be inner London boroughs, particularly Camden, Westminster, Kensington, Wandsworth, but also other areas singled out Cherwell, Mid Suffolk and North West Leicestershire. Areas that have kept rates low and done well out of business rates retention is what the IFS is saying here. And the reforms are just likely to be based on house prices, like, having a big change around. There was also floated the idea of another band, kind of almost like a super wealthy band, which I would presume that they would class anything as super wealthy as a house that's worth more than, say, £1 million or £1.5 million.
Well, Lee, what surprised me, actually, I didn't realise this, when I was looking at the Westminster council tax, because I was like, why a band H? But band H is the highest in Westminster, and that's over 320,000, which is odd because you would think 320,000 would be more like a D. But surely you could quite easily implement sort of extra bands for properties in places like Westminster that don't have that.
Well, exactly. I mean, I can't imagine there's many houses or properties worth less than £320,000 in Westminster. But when these bans were made, it's different kettle of fish, isn't it? And that's the argument. These things haven't changed. Should there be an extra band for some of these councils in which council tax is very low? But then the argument is, some of these bigger houses, I constantly see this in our reader comments. Well, we've got bigger houses, we've got the same amount of bins. Yeah, that is the argument that gets thrown back. And people, I think, are fed up of council tax funds being misused and not actually improving local services. But don't get me down that road, because I will be here all day. But what I'm trying to say is that there is a lot of kind of anger, I would say, around the council tax thing, really highlighted by J out of the In-Betweeners, which is a sentence I never thought I'd be saying on this podcast.
That's it for part 1.
Take control of your finances with Charles Stanley Direct. Invest, save, coach, or plan. Using technology where it's helpful and people where it matters. Our website and app make trading cost-effective and flexible. But we're more than just an online investment service. We're here for you regardless of your financial needs or if your life takes an unexpected turn. Your finances, your way. Take control today with Charles Stanley Direct. Sign up now.
Investment involves risk.
Welcome back. Crane has been back on the case, and this time she takes on a water company that dished out some bad advice. So last autumn, says the reader, my water pressure at home became extremely low. So much so that the reader and his wife, both in their 80s and he registered disabled, couldn't even have a shower in their own home. I contacted our water company, United Utilities, and someone was sent out to investigate in October. They said the water supply pipes needed to be replaced. This took months. It required the excavation of our front lawn, for which I paid £1,776 to a local contractor, as well as £1,783 fee to United Utilities to replace the pipework. Unfortunately, These works made no difference to the water pressure in the house. In April, a second United Utilities engineer visited and said the water meter needed replacing. This was free of charge and fixed the water pressure problem instantly. United Utilities offered us £300 in compensation, but I feel, unsurprisingly, my words, this is not enough, given we paid £3,559 and couldn't shower for 7 months. Helen, I had an issue with this. Actually, when I was living in Fulham, that my shower water pressure wasn't working. I had to go to my local gym to have a shower, but that was just for a few days. Very inconvenient. This has been 7 months, or had been 7 months.
Oh, I can't even imagine, honestly, Georgie. I've had a similar problem, having to go to my friends down the road to shower, and it drove me absolutely bonkers. And, to think as well, this couple are elderly. The man is unfortunately disabled, and it was actually their daughter, the man's daughter, who got in touch with me to begin with. And she said that she'd been picking them up and taking them to her house so they could shower. I mean, it's absolutely appalling. It should have been sorted so much more quickly. It's really one of the cases that I've had recently that I think has been the most shocking. So obviously this mistake has been made. They've come out, the water pressure isn't working. United Utilities have rightly sent someone out to have a look at it. And they decided that it's a problem with the pipes that go from... I've learned so much about water drainage and supply this week, honestly, Georgie. So there's how the supply works is there's sort of a big water pipe that goes under, for example, your road, and then there's a connecting pipe which takes that into your house. And if this pipe is inside the boundaries of your property, you have to pay for that to be fixed, which is why this person ended up paying this £3,500 to get this sorted. So, and I can completely understand why they did that. If someone from a water company comes around and says, your pipe's bust, you're just like, yeah, sure, it probably is. You don't know about how your water meter works, really. I mean, I have a water meter. Do I know how it works? No. If someone comes around and says your pipes are broken, do I just agree and say, well, I guess I just have to pay? Yeah, I absolutely do. So this means digging up the garden to get to these pipes, which is gutting. I recently got my first garden. I would be distraught if someone said we need to come and dig this up after I planted all my little flowers and done my I'd be so upset. So there's that, and then just the disruption, but it's terrible, and I really do think, obviously it turned out that after they'd paid for all this work and had all this disruption, it didn't fix the water pressure. So United Utilities come round again, and they say, oh no, actually, we didn't check the water meter before, and the engineer literally just takes the water meter off, blows through it, and it's like, it's blocked. No air can get through, so the water's not getting through. So that's the problem with the whole system, which is crazy. Water companies give out water meters for free, so this would have cost them nothing if they checked that to begin with. So then, they replace the water meter. Obviously, it's sorted. But then when they go back to the company and say, excuse me, this is terrible. We've just paid thousands, and it was just an issue with a water meter. They said it wasn't their policy to check water meters when the water supply went off. It's like, why is it not your policy? It's just so silly. But I think to a sort of more serious point, water companies are really fast becoming the sort of big baddies of bill charging companies, I feel. Obviously had all this terrible stuff about dumping sewage, and that's feeding into customers' bills. We're all paying for them to fix those things, and water bills are going up. And then when they do something like this, it just isn't really helping their case at all, is it? Luckily, when I contacted them, they did. So before I contacted them, they'd agreed to pay £300 in what they call compensation, but it's not compensation really, because it doesn't even cover a tenth of the cost of what they paid. And also they said they were going to charge VAT on it, so it would actually only be £240, which I think some people have... I know, but then which I think some people noted in the comments that isn't actually even the correct amount of VAT, so who knows what they were even trying to charge there. But luckily when I went to them, they quite quickly did agree that they would pay all the money that they'd spent out back, and they paid them £750 compensation on top, which I would argue doesn't make up for 7 months of not being able to shower in your own house, but it's something at least. So glad I was able to get it sorted.
Not if you're disabled and in your 80s.
Yes, exactly.
Lee, this is just absolutely galling, isn't it? And also the fact that, yes, as Helen rightly pointed out, they have become the big baddies here, but they're not doing themselves any favours. If they had just made it their policy, it doesn't seem a big one, just to check the water meter in the house, they could have saved themselves thousands. I mean, how many times do they do this? Just mind-boggling.
It was just when Helen was saying that they sort of blew into the pipe, like you would do old computer game cartridges. You got a Super Nintendo, just like blowing on the cartridge to make it work. And now it works.
Did they turn it on and off again?
Well, it feels like that. And actually, Georgie, this is one of the cases from the past year that I woke up the next day after editing it and I digested it a bit more. I was like, that is bonkers. It had bedded in. That is crazy that they've done that. Like, that's a lot of money. That's a lot of upheaval. And actually, I'm obviously editor, but also reader and like reading interesting stories. And this is definitely one of those where the reader comments. For example, someone said, amazing how quickly companies act once exposed in the media. Also seeing as this has cost United Utilities roughly £4,000 in compensation, plus the cost of all the unnecessary work done. I guess in the end, myself and the rest of United Utility customers will be forking out for their incompetence. And there's quite a lot of that in here. How on earth would this be the first thing to do? United Utility should be utterly ashamed of themselves here, as someone put in the reader comments. Incredible amount of upheaval, cost, and in a time when they are the baddies. Water bills have gone up on average something like 25%. I think this year. Some people have seen bill rises far higher than that. The whole water industry absolutely feels rotten to the core at the moment. And this story is just one, I'm sure, of many incompetencies across all of the water companies that we are fed up with.
Hear, hear, Lee, hear, hear. Last week, the Supreme Court largely overturned a Court of Appeal ruling on car finance. That's where we're headed next. That would have seen compensation payouts of up to £44 billion. But the scandal is far from over. Lenders could still be on the hook for between £9 and £18 billion after the city regulator announced it would launch a compensation scheme for those affected. Lee, that still seems quite a high figure. So I thought, on one hand, when we got the Supreme Court decision, that, all right, that's it, it's over. And a lot of people agreed that we don't want another PPI payout, etc. But now we've got a situation where, well, people could be entitled to compensation. Before we get there, give us a recap, Lee. What is this all about?
Oh, sorry, Georgie. I'm doing a nervous laughter because last Friday I was at my desk till something like 9 o'clock, puzzling all of this stuff together, because last Friday they didn't put the announcement out until 4:35 p.m. after the markets closed, in case the lenders that were involved in this, there was big swings in what the decision meant. But of course, 4:35, getting the document is one thing, and that seems like wading through treacle. Can you imagine how much there was in this? It was absolutely incredible. 3 cases had been taken to the Supreme Court over this. It has been a feeding frenzy. Even last Friday morning, I kid you not, through my letterbox was a leaflet saying you could be entitled to compensation if you'd taken car finance out between 2007 to 2021. It has been absolute carnage. There's been claims management firms out there rubbing their hands waiting for this decision. Now, I'm not going to go into all of it. I'm just going to go into the important parts, because it's not complicated, but there's just a lot to it. But something like 2 million cars are purchased using finance deals every year. As many as 6.6 million people unwittingly signed up to a discretionary commission arrangement, which is called a DCA. This is where they paid more in loan interest than they should have done, which is a ruse bumped up by the commission salesman could earn. Now, what we mean by that is basically salesmen weren't acting in your best interest quite a lot of the time, shock horror, and were charging more interest than they should have done. Now, the difficulty about this, and as you rightly say, actually, there was this whole thing about it being PPI on wheels, and it might cost the industry 44 billion, but it's still going to potentially cost the industry up to 18 billion, which is no small fry. Roughly about 950 quid up to, depending if you had more than one car finance agreement, which between 2007 and 2021 is quite likely, you might have had more than one personal contract purchase or hire purchase agreement between those times. So you might be entitled to a little bit more. Now, of course, a lot of people will go, well, hold on, I did have car finance in 2007, 8, 9, 10, 11, 12, 13, 14. I don't have the paperwork for that. Like, what on earth am I meant to do from that? Really, the onus is on the car finance provider to have kept the paperwork, even though we're kind of told 6 years is the longest time necessary. But the FCA have got involved in this, and the FCA are kind of poring over the details of this and whether it should just be blanket compensation, whether you need to apply to try and get compensation for this. But also, don't underestimate Britain's ability to keep hold of paperwork. I maybe just speak for myself here, but I definitely have one of those kind of folders where you just bung in paperwork, and I very rarely get rid of it. So I think, it might come in handy at some point. And I don't think I'm alone, because Toby Wall, now one of our reporters, is currently pouring through loads of people's contracts, car finance agreements, as we speak, because people have kept hold of it. Now, I do have an example, Georgie, of how rife this was and what was going on. So I've never had car finance, and in 2018 found out that my wife was pregnant. We were driving a Ford Fiesta. Loved the little 1 litre EcoBoost Ford Fiesta. Wonderful car. Zippy, brilliant. Couldn't deal with the rigours of family life. There's no way I was bunging in a giant buggy in there and everything else you have to throw in when you have a child. So we went into a car dealership. I won't reveal which one because I don't want to get into a legal headache here, but went into a car dealership. We'd done lots of research, aka I'd asked motoring editor Rob Pole, what car should we buy? Need a bigger car. And then we sat down, he told me what we should get. Went into the dealership, sat down with the salesman, want this model, and we want little luxury touches, leather interior, heated seats, kick boot, feeling like real middle-class adults. This wasn't a massively disgusting expensive car, Georgie. £28,000 is expensive, but, not compared to what you can get potentially. But building all this car, salesman, looking forward to being a parent and really nice, and we go for all the chit-chat and whatnot. And then he said, right, let's get to the car finance agreement. And then actually my wife, I remember saying, oh, actually, no, we're not doing it on finance. We've got savings to pay for the car. And can we have a discount as cash buyers? And the whole demeanour of this salesperson changed. Oh, you're cash buyers. You're not putting it on finance. And I remember walking away thinking, is it because he's missed out on commission? I genuinely walked out of that dealership thinking, would he have earned more if we had put this on finance? And he was very, very insistent that we took out car finance. I was very insistent that we weren't going to take out car finance. Now, I know you're listening to this going, when you buy a new car, you drive it away and it loses half its value, which is the common advice, isn't it? And actually, this is what this guy started saying. And it makes you, buying a new car is such a strange business. Where else in life do you buy something and then within 1 minute of ownership, it sort of like halves in value? Such a weird concept to get your head round. But just to say there's method behind the madness, we planned on holding it for 10 years. £2,800 a year or £233 per month. We had savings, we had a lump sum, and that £2,800 a year and £233 per month figure doesn't include when we eventually sell it on, so that will get even lower. We have had the car for 7 years, 60,000 miles, one careful owner, no problems with it, to the point where I think we might even potentially hold on to it for another 10 years because we aren't materialistic. I'm not bothered about what badge we drive with car as long as it does the job. And sometimes when we have 2 young children now, that car's a wreck. It gets treated like a fourth bedroom of the house, just all stuff in there, buggies in there, kids spilling stuff in there. We are not fussed about getting a 60, 70, 80 grand car, trading it in, making balloon payments, all that stuff. Like, this is what we wanted to do, and this is how we did it, but he was not happy about it. And now I think that this case, when I can picture I can honestly picture the man's face, and I can picture the moment his face dropped. I don't know if you watch The Simpsons, Georgie, but there's that bit when Lisa and Ralph are doing Valentine's Day cards, and Ralph's heart breaks when Lisa sort of says she's not interested in him. That's what the car salesman, I can picture the exact moment his face dropped when I said we weren't interested in car finance. Sorry to bring a Simpsons reference up, but, sometimes you've got to bring this car finance and money stories to life, haven't you? But yeah, so there we go. And are you entitled to compensation? Quite possibly if you had car finance between 2007 and 2021. Do not, I repeat, do not use a claims management firm. Do not. Don't panic into signing up to one now. Wait to see what the FCA say and what the next steps are going to be. But you do not want someone, a claims management firm, taking a cut of what potentially, if you've overpaid on your car finance, it should be a relatively straightforward process to put a claim in. And in the meantime, if you're confused or not too sure, we had a case study in the story that we had in the paper on Wednesday, and he's written to all of the car finance providers and manufacturers that he's taken finance out of in the past to find out what the next steps are. There's no harm in doing that as well.
I'm going to channel my inner Helen here, who, as much as she likes to point out and hold the bad guys to account, Helen, you also like to give praise where praise is due. Listening to your story there, Lee, about going into the car dealership, I want to praise, and it took me a while to think about this because I bought my car 6 years ago, very similar to you, Lee, or exactly the same. I was buying the car with cash. If I can't afford something, I won't buy it. Vauxhall SLM in Tunbridge Wells had none of that. They could not have been lovelier. They were brilliant, provided me great service. I can't even remember that they offered me any sort of finance. I'm sure they must have done, I don't know, but absolutely wonderful. So the yin to your yang, or the yang to your yin there, Lee.
And it's true, Georgie. I'm not trying to tarnish all salespeople with the same brush here. So I don't mean to sound like mean about salespeople. It's a tough job, and I'm sure that this is just a one-off case that happened to us. And actually, where else in life do you make such a big purchase and then not mention up front how it is that I don't know how the conversation hadn't begun with, right? Can you afford this car? Looking back now, it would have been like, well, how are you paying for this car? But it probably shows you how simple it was to get car finance at various levels, quite simply with very little checks. But where we can have a go at them is for these discretionary commission payments, because if buyers have lost out and paid more than they should have for their car finance because of some underhand tactics, then those people and those car finance firms and those manufacturers should be massively called out. What I'm trying to say is not always, especially when it comes to finance, are people acting and companies acting in the best interest. And you should always check through your terms and conditions. The trouble is with some of these car finance deals is that the terms and conditions are beastly, absolutely huge, and it's a purchase. You're excited to get a new car. So are you going to realistically look through dozens, potentially hundreds of pages of terms and conditions to try and unearth every single facet of what the deal entails? Almost impossible. And I think that's where a lot of this boils down. A lot more of our financial life should be made simpler by having clearer, shorter, easier to understand terms and conditions, rather than hiding behind subsection clauses, turn to this page on this page to find out about X, Y, and Z. And I think that's what a lot of this boils down to, the language used. And if salespeople were acting out of their own interest to try and earn more commission by doing something that was not correct for you, aka charging you more interest than what should have been charged.
All right, Lee, thank you very much. Thank you, Helen, and thank you for listening. That is it for this week. You can keep up to date with all the latest breaking money news. Just go to thisismoney.co.uk or download the app. And if you have any comments or questions to the team or anything you'd like them to look into, Lee?
Yeah, you can email us at podcast@thisismoney.co.uk. Come visit the website thisismoney.co.uk and find the podcast story, and you can comment in there. And you can also X us at This Is Money, Facebook us at This Is Money. We'll see your message eventually, so do get in touch.
And if you like our podcast, why not rate us wherever you found us? It helps other people find us too.
Take control of your finances with Charles Stanley Direct. Invest, save, coach, or plan. Using technology where it's helpful and people where it matters. Our website and app make trading cost-effective and flexible. But we're more than just an online investment service. We're here for you regardless of your financial needs or if your life takes an unexpected turn. Your finances, your way. Take control today with Charles Stanley Direct. Sign up now.
Investment involves risk.